Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor. I'm speaking to you from New York City on the 22nd of October, 2019. I like to remind you each week I am the author of Jay Taylor's Gold, Energy, and Tech Stocks. You can sign up for my newsletter that focuses almost entirely on the exploration sector, the gold and silver exploration sector. We do talk, of course, a little bit about the economy and the markets in general. And we rely on our good friend Michael Oliver to pass a few of his grains of wisdom along to our subscribers from time to time as well. Michael will be with me in just a minute to share some of his thoughts with you. Would like to suggest that you go to olivermsa.com to learn more about Michael's work. It's excellent, which is why he's with us almost every week on this show. Also like to encourage you to go to Chen Lin's website, chenpix.com to sign up for his excellent newsletter. Chen focuses to a great extent on the biotechs, also on the energy sector, and also to an extent on the mining sector as well. And Chen sort of moves from sector to sector depending on which ones you can make more money in, rather than yours truly, who tends to stick more or less with the mining sector through thick or thin. Chen is more opportunistic in that regard, moves into sectors that are doing very well. So he is becoming a bit more interested now in the mining sector than he has been in the past, I should say. So chenpix.com is the place to go for Chen Lin's letter, What is Chen Buying, What is Chen Selling? And I do want to thank you for listening to this show, all of you, making it one of the more listened to shows on the Voice America Business Channel. And also encourage you to send along any comments you might have about this show to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com. And last but not least, we do want to thank our sponsors for making this show economically viable. Our sponsors for today's show, Novo Resources, Great Bear Resources, and Irving Resources. I've titled today's show, Big Profits from Armageddon. Richard Mayberry and Michael Oliver return, as I just mentioned. Michael will be with me in just a second. Addison Qualley visits for the first time. The title of today's show, Big Profits from Armageddon, was taken from a subtitle from Richard Mayberry's most recent monthly letter covering the months of October and November. Many people equate the word Armageddon with the word apocalypse to mean the end of the world, usually in biblical terms. But actually, Armageddon refers to a hilltop where Christian believers will gather and be saved from the apocalypse at the end of time. Well, I'm quite sure Richard wasn't really talking about the end of time. I don't think that's exactly what he had in mind in his article, but he did focus on the potential use of nuclear weapons in an increasingly unstable global political environment. Richard has some very interesting thoughts about Donald Trump and past presidents, and he believes that despite much consternation in the news about the current president, some of which he shares, you shouldn't worry, but rather find ways to profit from what is likely to take financial markets down hard, in Richard's view. So we'll ask Richard to talk about that, walk us through his thinking in this matter about how you can actually profit from bad things that take place in this world. For the longest time, one of the major excuses for not owning gold was that it pays no interest. Well, that simply is no longer true. Addison Qualley of Monetary Metals will be with me right after our first commercial break to explain how you can actually generate positive yields of 2% or more from leasing your gold in what I believe is a very low-risk endeavor. So at a time when the world is sending money to the United States in desperate search, for high-quality, positive-yielding debt instruments, yielding investment grades, positive yields in U.S. dollar debt, there is a safer way for investors to earn yield that is as good or better than investment-grade U.S. debt instruments, and that is by leasing gold. Not only can you enjoy positive yield by leasing your gold bullion, but the interest that you earn in your gold lease is also in gold. And, of course, gold retains its purchasing power over long periods of time. Addison will be with me right after the first commercial break, as I mentioned, to explain the Monetary Metals program and how you can take advantage of it. Certainly, if you take a long-term view of gold as a store of wealth, it is easy to realize that gold is eternal wealth, at least until the end of time. So while some of you may be concerned with the recent weakness in yellow metal, I'm really happy to tell you that Michael Oliver is here to help calm your nerves. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you with me. And one of the things I really appreciate about your writing, it is a technical approach to the letters, your proprietary technical approach, actually, which is why not every Tom, Dick, and Harry is using it and why I think it's effective. But you have also a clever way of writing. I think for someone who's so technical, you also have some interesting, you parse words in an interesting way. So the titles of a couple of your recent letters, Sense of Ripening Conditions, referring to the markets, that there's some ripening going on and some markets are ready to, are maturing and getting ready for the next move. And another title was Movement Now by Major Markets. Gold is watching those moves. So I know we kind of covered this topic last week, but your idea was that for gold to make its next major move, probably going to have to see some changes in some key markets like the dollar, stocks, and commodities. Where do some of those key markets stand now? I know we just talked to you last week, but do you see any, what are your thoughts about those markets now?
Well, when we measure them via long-term momentum technical factors, not just looking at the price charts or reading the headlines. Mm-hmm. But two of the most dormant markets we've seen in years, go back about a year or more in the dollar, and you'll see about a 3% range. Go back to 2016 and look at the Bloomberg Commodity Index, and you'll see a very narrow range. Basing out after a major collapse, dollar after a rally, it stalled. And so both markets are quiet, but they're major. They're huge asset categories. And if they do move, we suspect they'll move pretty sharply and violently, it will shock most people who are watching markets because, frankly, they've been lulled to sleep looking at the dollar, which they consider, quote, firm, and commodities, which they consider depressed, and that's true. But commodities aren't going down, and the dollar is not going up. The dollar's where it was 14 months ago. Just draw a line sideways from August of 2018. So now, if these two market categories can move, it will no doubt generate investor preference shifts further than what we've seen. We've seen, obviously, an investor preference shift for T-bonds and for gold. They've gone up sharply over the last year. Price in bonds drop in yields and a large rise in gold. But gold's done that without any assistance from what you would consider to be the normal factors that might drive gold, like a weak dollar. It's not been weak. It's been sideways to up slightly. And if you look at commodities, they've not cheered gold on with the commodity price rise. Instead, what we've seen is a commodity sideways action. Mm-hmm. So there's been no cheering from the commodities behind gold, no second wind. And the stock market, if you look at it, go back to January 2018, it was at 28.72. We're all of about 3 or 4% above there now. So even the stock market, despite some violent downs and violent ups, is basically where it was a year and a half, almost 2 years ago. So these three major asset categories have not sort of sponsored gold, but gold's done it on its own. Okay, our assessment was a month ago, when gold was in the mid-1500s, that it would go into a consolidation zone, take a breath, after a huge move, and wait for one or more of these categories to shift trend. Well, the stock market is still not comfortably, single percentage-wise above levels that we determine will collapse it. Not take it down, collapse it. Okay, but it's 5% above our first level and about 8 or 9% above the second level. Let's take the S&P off the page. Let's go look at the dollar. The dollar has dropped a couple of points from above 99 down to 97 area, and we have a trigger number in the low 97s that if you close a month below it, we think it's topped and it will head down, probably with some whoosh effect, which will surprise people, again, because they're asleep at the switch. Meanwhile, the exact opposite is occurring with the Bloomberg Commodity Index. In fact, if you look at our momentum studies of both, they're inverse. They're mirror opposites. One is living above a certain structure, the three-quarter moving average on the dollar, and one is living below it, the Bloomberg Commodity Index, for the last year and a half, trying to get above it. Well, right now the Bloomberg Commodity Index is all of 1% below our upside breakout level, and the dollar has actually traded at and below our downside breakout level. So they're both at the gate, is what I would label them. These are two major categories, and we think if they shift, and we think they'll shift opposite, pretty much in sync with each other, that should definitely inject some new strength into the gold market. This time around, you'll have external evidence that justifies the gold move to the upside. And I think that's pending. I think we're there. We're staring at the gate right now in both those major markets. And so we've urged our gold investors to, instead of looking at the day-to-day nonsense action in gold, which is up, down, up, down, up, down, with a very little deterioration over a 3-month period, to look instead at the dollar index and the Bloomberg Commodity Index as the next major factors for gold.
All right, if the dollar and commodities are at the gate, Michael, what about the T-bond? My big question in my mind is when and if does the T-bond no longer provide a safe haven when the equity markets or other things go wrong?
Yes. That will be scary, and that's fine. It will happen. The T-bond market, talking price up now, we called an upturn in December of last year. T-bond futures were in the 140s, low 140s. They shot up to near 170 recently, and now they're congesting. They've had a pullback, pretty sharp pullback, about 10 points in the bonds. And the yields have risen. This is talking 30-year bond futures. This is also true, by the way, with the German Bunds, 10-year Bunds, and the JGBs, Japanese government bonds, which have also dropped back down in price, therefore risen in yield, which, of course, is not something that the central banks of those countries wanted to happen, but it happened because market forces are in charge here. We're not sure right now whether the bonds are ready to top, meaning actually rise in yield on a sustained basis. But they are at a structure that either they break it now in the next few weeks, or they hold it and rally back one more time, meaning we get another drop in yields. It could be that if the stock market weakens, obviously what will happen is more investors will jump back into bonds again. But ultimately, this T-bond market is not in a position for sustained upside, meaning sustained lower yields. It's setting up for a downturn, meaning higher yields on a sustained basis, which, of course, would be total chaos for the central banks if that happened.
Oh, boy,
we think it will happen. We're just not sure that it's going to happen now. It may be, probably by the end of the year it will happen, but we're not sure that the recent drop in bonds is the start of a downturn in price for T-bonds.
All right.
They could very well hold here and sustain for another month or two prior to a drop.
Well,
that will be a chaotic event.
Yeah, I was going to say that's going to be a really big one to keep our eyes on, and we'll be no doubt asking you about that to comment on that going forward. With just about a minute left here, Michael, you sent me a note. You said the assumption by the Republicans and Trump folks is that essentially as long as the economy remains strong, they pretty much don't have to worry about Trump's reelection. I mean, to me, that's, first of all, I don't believe the economy is everything that's cracked up to be to start with. But what are your thoughts on that, and what might that mean for these markets if it starts to look as if we might have an Elizabeth Warren or somebody of that far left ilk? What are your thoughts about that?
Even if it's not Warren, if it's anybody on that side that wins the presidency, that means that Congress will also go that way, which means a lot of people who are of socialist leaning will go that way. Okay, right now that assumption's not really popular. It's not assumed to be a likely course. But I caution that our work says that the S&P 500 can't even sneeze. You can't even begin what is called a minor correction. If you do, there are structures below on momentum that say it will be a rapid demise. Okay. What leads? Does the market lead the economy, or does the economy lead the market? Most people think that economic metrics, the stuff we see on Fox Business News and CNBC, that, what's this number, what's that number out of the government, those are the determining factors. I argue the other way around, and we've seen it before. If the stock market goes, those numbers will go. So reverse cart before the horse, reverse it. If the stock market goes, it will take those economic numbers that Moody's recently said will give Trump a landslide, assuming those economic numbers prevail. And we argue that what will cause those economic numbers to turn is the stock market, the inflated bubble. And if it goes, all those numbers, you can flush them. They'll change dramatically, rapidly. In which case, the assumption that he has a solid economic background for him to get reelected on could go like a light switch.
Well, it's very shaky, I think, and indeed the connection is, of course, the massive amount of leverage to the stock market, and how many, even pension funds and the like that have gone out on the high, taking up all that risk in the equity markets because they can't get yield in the debt markets because of the, I would say, the bastardization of the debt markets by the central banks. And it's there's likely to be trouble ahead. It is a dark picture, but we're going to do what we can. All right, Michael.
But again, it's like you said, make money.
Well, and that's exactly, we're going to be talking to Richard Mayberry in the last section of today, trying to figure out how we can, perceive what's going to go wrong or what's likely to go wrong, and then do the best we can to profit from it. So thank you very much once again, Michael, for being with us and for your insights. Always appreciated, even when they're gloomy.